In this video, you're going to learn why. Hi, I'm Uncle Wealth. Welcome to the Satoshi African Academy channel. Here, we're working to spread crypto adoption across Africa for legally productive use cases. Now, let's jump right into today's topic. In today's video, you're going to learn three things. Number one is how to spot strong trends using the EMA 50. Number two is how to avoid bad trades in ranging markets. And number three is the best candlestick pattern to time your entry. Now, before we go further, what exactly is the EMA 50? Well, on this chart, what you're looking at is the 1000 Pepe USDT perpetual chart, and the EMA 50 is basically the exponential moving average that measures the average for the last 50 periods. Now, this works on any time frame, whether it's the 1 day, the 1 hour, whether it's the daily, whether it's the weekly, whether it's the 1 minute, as long as there are up to 50 bars on that chart, you're going to see that the 50 EMA will appear once you set it up as an indicator. Now, one of the things that make the EMA 50 very, very useful is because, unlike the simple moving average, the 50 EMA focuses on the latest price action, the latest bars. It measures the recent averages of the recent bars. Now, think of it like this: if you are selling bananas and you want to know, when to restock, when to buy more, or when to just hold off from buying, or when to reduce your price, or when to sell. So basically, you start tracking the last 50 days of your sales, and then you check the average on every day. Now, with the EMA 50, you are looking at the last 50 bars. You're not using data from a flat data that is just based on whenever it is the trade started. You are looking at the last 50 bars. So you forget about the old price action. You're always looking at the last 50 bars. That is how the EMA is being plotted. With the averages of the last 50 bars, the EMA 50 plots that. So on my chart here, the EMA 50 is the gray line you are seeing here. The gray line you're seeing here. And I use the yellow bars for my bullish candles and the gray bars for my bearish candles. So now you understand that the EMA 50 is plotted based on the average of the last 50 candles. Now you need to ask yourself, how do we identify strong trends on the chart using the EMA 50? Well, I'm going to show you. For strong trends, this is what you're going to notice. You're going to notice that the EMA 50 is going to move away from the candlesticks. So let's look at this. These were the candlesticks patterns. They're moving here. But you could notice that the EMA was also moving at an increasing angle. Let's just think about it like, a roughly 45 degrees angle. It's not perfect. Just visually, you can see that it goes wider. So when there's a strong trend in the market, it is easier for you to notice that the EMA 50 is going to pull away from the bottom of the candlesticks. Now, what you don't want to see is the EMA moving, in parallel lines close to the bottom of the candlesticks. You want to just see that wide push away from the candlesticks. So once that gap is being created, you just have to know that that trend is a strong trend. Now let's look at it on the chart and see how to identify such positions on the charts. All right, you can see one here. You saw that the candlesticks were moving up and the EMA 50 got wider until this point. All right, so in that case you can see that the trend was very strong. Let's go and look for another one. Now for this was an uptrend. Now over here was a downtrend. You can see here in the downtrend the EMA 50 was moving, and then the candle moved away from the candlesticks moved away from the EMA 50. This showed a strong downward trend. So one of the things you notice there is that there was an impulsive move in that area. So just keep that in mind. Let's go look for another area. This was another one. You could see that the EMA 50 moved away from the bottom of the chart, candlesticks. So whenever you see that happening, just know that the move is a very strong trend. Look at this area. You can see here the candlesticks moved here and the EMA 50 moved away from the bottom of the candlesticks. Now if you understood what we're saying here, you notice something, and that is that every time the EMA 50 went below the candlesticks, whenever the EMA 50 went below the candlesticks, that was an uptrend. And every time the EMA 50 went above, every time it went above the candlesticks, you notice that the trend was downwards. Look at, like in this area, you can see that the EMA 50 went here and then it went above the candlesticks while the candlesticks went lower. So you just want to see that push. You're factoring a 45-degree angle. So once it just moves away from the candlesticks, you just know that the trend is strong. All right, now we've gotten that out of the way. Let's talk about how to avoid bad trades using the EMA 50 as our guide. Now, one thing you have to note is that you have to work in confluence with your other parameters that you use to check in your trade. Now, to avoid bad trades, it's always best for you to just, sit on your hands whenever you see the price ranging. So how do you know when the market is ranging? All you need to do is just pick your rectangle tool and draw a price box. Like in this region, you can see the market was ranging. All it just did was moving from the bottom to the top of the rectangle, went and touched, came back to base, came back. It was just ranging. So these kind of markets are what we call choppy markets. They're just sideways movements. So you cannot rely on this particular sideways movement, especially in a lower time frame, to give you, a reasonable opportunity to trade, because if the market fluctuates, it can take you out. It can hit your stop loss, and if you don't even use the stop loss, it can just wipe you out, depending on whatever is going on in the market at that particular moment. All right, so let's look for another ranging market. You can see at this point in time, you can see the market is ranging. You notice this, the market is ranging here. You can see that. So what you are just seeing is the highs of the market. Once you understand market structure, if you've not yet understood market structure, you go and watch market structure video. But what you're noticing here is that based on the market structure, you can see that the price is ranging within the price box. It just hits the top of the box and comes down to the bottom of the box. Then, now, one of the things you notice about the EMA 50 is that it helps us already visualize the areas where price is moving in a range. And what you notice is that the EMA 50 starts to behave as if it's turning into a 180 degrees line. You just notice that it's just kind of moving like, you know, a parallel line. It's not perfect, but it's just a wavy line that, you know, hovers over, you know, a straight 180 degrees line. You just notice that ranging. So the EMA 50 just behaves like that whenever it's in a ranging market. So one of the things it does is that it visually helps you to identify, you know, areas where the market ranges. So as you can see, it was moving in that line. It just moves. Why? Because we are having roughly equal highs and roughly equal lows here inside this particular price box. So let's go and look at other areas on the chart where the EMA 50 was ranging. All right, we can see, okay, you can see this is another area. Now after this downtrend, you notice that we could draw a price box from here to here. What you could see was that, you know, the prices were just ranging. It goes to the peak, comes down to the bottom, the peak, the bottom, the peak, until it broke out of the price box and then gave us, you know, a strong uptrend, which you could notice that the EMA 50, you know, started pulling away from the bottom of the candlesticks. So when you just see, you know, the sideways action, just it's best to just stay away from the markets, because any trade you enter there is just likely, you know, likely not to favor you. And you can see the way the EMA 50 behaved. You can see that the EMA 50 was moving like a wave. You know, think of it like a wave, and there's an invisible 180 degrees horizontal line. So the wave is just moving around that. So that's how the EMA 50 behaves when it's a range. So visually you can already spot that, hey, this is a ranging market. But when the trend is strong, like I said, so you will notice that the EMA 50, if it's an uptrend, the EMA 50 is going to pull away from the bottom of the candlesticks. Now, if it is a downtrend, it's also good, and if it's a downtrend that is strong, you'll notice that the EMA 50 is going to pull away too from the top of the candlesticks. So you have known that now, that when the move is strong, there's going to be a roughly 45 degrees pull away from the candlesticks. If it's from the bottom, you know it's an uptrend. If it's from the top, you know that it is a downtrend. And then when you see the EMA 50 behaving like a wavy line, you know, with an invisible horizontal line in the middle, let's call it 180 degree horizontal line, what you can say is that market is ranging. And the proof that market is ranging is that you can easily draw a price box with your horizontal tool, factoring the bottoms and the top of that range, and then all you just need to do is sit on your hands and wait for price to break out of that box. The best trades that happened outside that box will be when the trade moves, when the candlestick moves, with an impulsive move, out of that price box. All right. So, what are the best candlestick patterns to time your entry? For entries, all you just need to do is look for an engulfing candle. That is just one of the best. If I always recommend an engulfing candle. Why an engulfing candle? Because an engulfing candle just shows, an impulsive move, towards a particular side. So, let's look for a strong trend. Look at this. Look at this area. Now, in this area, what did you notice? You see that price ranged from here to here. Then we got an impulsive move out of this price box. So you need to see that breakaway with an impulsive move, showing that, hey, a particular side is in control of the market. Either it's buyers, there are more buyers in the market, and with the more buyers in the market, you're going to see a very strong uptrend. You're going to see a pull away of the EMA 50 from the bottom of the candlesticks. And when you see that, you just know that that is a strong, breakaway. So you need to see an impulsive candle, or you need to see an engulfing chart pattern. An engulfing candlestick chart pattern. So look at this. Look at this region over here. Look at this region over here. You can see what price did. Because this was an impulsive move, you could see that the EMA 50 pulled away from the candlestick, the top of the candlestick, because it was a downtrend. So you could see this, and this happened after price broke away from this range. After price broke away from this range. So the price box helps you to identify the range, and you could see, notice something about the EMA 50's behavior here. It was just waving, not perfect, but it was just waving, moving like a flat line in this case. So you either see it like a roughly flat line, or you see it as you see it as a wavy line. So if you have this, it's not perfect, but if you have this, the EMA behaving like this, the EMA 50 behaving like this, that's a price, a ranging market at that particular point in time. If you see it as, behaving like a wave with an invisible, horizontal line, is still, a price box, a ranging market. So in that situation, all you just need to do is just draw your price box, and then you sit on your hands and wait for price to break out of that price box. Now, what you're looking for is an impulsive move. If you don't see an impulsive move, don't do anything. It's better for you to sit and wait for quality trades than for you to just jump into the market and then, you get stopped out because you did not wait. One other thing is that you have to understand that the lower the time frame, the louder the noise. So it's best for you to stick to time frames, that are higher, except you just want to scalp. So if you're a scalper, all these tiny moves, would really favor you. So another chart pattern you can look at, apart from the engulfing candlestick, is the double bottom, double bottom, double top chart patterns. So those ones can help you. You combine them with the EMA 50 to check for impulsive moves, and when there's a breakaway, that's when you now take advantage of the moves of the market. So the EMA 50 is very, very handy when it comes to identifying the trend. So it's best you should just stick to strong trends and enter your trades when the trend is strong. Like I said, so one of the things that you're going to notice before a strong move is you're going to see that the market is going to range. And when the market is ranging, you're going to see that it's going to fit into a price box. Now keep in mind that this price box is not perfect, so just forget the textbook stuff. Just stick to just what you are seeing. If you don't see something that you can explain easily to a 5-year-old, it's just best not to do anything. Just sit on your hands. Yes, if it is not visually visible enough for you to point it out easily to a 5-year-old, just sit on your hands. So you can see in this particular price box, you can see that the EMA 50 was moving, roughly, close to a 180 degrees horizontal line, but it was wavy. So that's a price box for you. So stick to that and use other confluences that you use to favor you. One of the things you should notice is that when the move is impulsive, if you are using confluence with the volume indicator, if you're using the volume indicator, you notice that the volume is going to be the volume will increase when the trend is strong. And one of the things you notice about the EMA 50 in confluence with the volume is that when the market is ranging, you notice that the volume is low. If you check down here, you see this area. If you check down here, you see this area, with our volume indicator, all this area, you notice that the volume is low. So when the volume is low, during ranging market, it just tells you that, hey, a lot of experienced traders are just sitting on their hands. At that particular time, there is no incentive to enter the market. And when you see all these, once in a while spikes, just know it's likely someone is either dumping or someone is just buying. And like I said, so different traders, have different reasons that they are trading. So keep that in mind and make sure that whatever strategy you're using, make sure that it has confluence with other signals that you use to enter your trade. So for me personally, I like to see an impulsive move before I enter a trade. So an impulsive move that breaks away from a price box, gives you more incentives to use the to take advantage of the EMA 50 to enter your trades. So you have to keep in mind that this EMA 50 technique works for crypto, it works for Forex, and it works for stocks. So don't limit yourself. Don't limit yourself to just crypto. If you are also into Forex, take advantage of it. Take advantage of it. The EMA 50 is here to stay, and most chatting platforms, they have made it available for free. So take advantage of it. And lastly, some of the things I should point out is that you need to manage your risk well. So don't over leverage, because like I said, so the EMA 50 is just a guide, and you can see sometimes there can be spikes in the markets. Like you see this was a spike. Now because this is a spike, these spikes can take you out. So if you are using a very high leverage, look at this particular candlestick. If you're using a high leverage, it makes it easier for you to be stopped out, and you can see that instant that you're stopped out, and then the market still moves in your direction, in direction according to your own bias. So don't over leverage. If you're leveraging, use low leverage, because leverage can work in your favor and it can also work against you. Also know the zone you are trading from. It's best to enter buy trades from the discount zone and enter sell trades from the premium zone. What am I saying? I'm simply saying this, that if you pick your Jan 2, by the way, here are the settings for my Jan 2. You can save them. 0, 1, and 0.5. The 0.5 is just the 50% level. So with your Jan 2, what you're going to see is this. You want your trades your buy trades to be inside this zone, the lower zone, because the lower zone is the discount zone. Now, the closer it is to the zero line, it's even better for you to enter buy trades closer to the zero line. And for your sell trades, you want to enter trades that are close to the one line, the one mark line. Why is this so? It's simple. It's just basic economics. You want to buy low and you want to sell high. Then for a sell trade, you want to sell high and buy low. So with this jam tool, you can identify your zones from the chart. So how do you draw them? Simply pick up your jam tool, then you check for the letter swing. You start from the bottom, always from the left to the right, to the highest point. So if you're understanding this, you can see that price right now is in the premium zone. So up here is your premium zone. Up here is your premium zone. And down here is your discount zone. Down here is your discount zone. So you want to enter trades. You want to enter buy trades at the discount zone and enter sell trades at the premium zone. So make sure that there's confluence with your higher time frame, and this will make sure that the trades you enter is going to be a high probability trade to give you profits. So I'm going to end this by saying don't complicate stuff. Yes, because the most profitable traders, they just like to keep things simple and execute ruthlessly. So once you see that everything on the chart aligns with your move, and whether you're using indicators or not using indicators, you just see that there's confluence, all you just need to do is execute. Don't be focused on trying to, get things right every time. We are dealing with a business that deals on probabilities, which means we are looking at probabilities that price behaves based on what it has done in the past. It doesn't mean that your trade is going to be 100% right. The most important thing is this: you are here to make money, not to prove that you are correct every time. So focus on high probability setups, and if you notice that you are not seeing what you need to see clearly in a way that you can call a 5-year-old and say, hey, this is this. If you're not seeing it that clearly, don't enter a trade. Now, if you like this kind of content, I want you to like this video and share it with your friends. Then subscribe to the channel. We really appreciate your support, and I will see you in the next one.